Hello everyone, Clifford Bennett, Chief Economist, ACY Securities. I hope you had a good rest over the weekend. In the week ahead, we're going to get some interesting data such as the PCE inflation indicator in the US and fourth quarter GDP in the US, which is expected to weaken from the 3.2 that it registered in Q4 on a year-on basis, down to about 2.7, 2.8%. So that's something to watch out for. But we all know the US economy is slowing, and that number is very backward looking. It's talking about fourth quarter, and here we are in February. So it's not exactly cutting edge to the day, but still it will have some interesting information. We did see some up-to-the-date data coming out on Wall Street on Friday, which was the US existing homes data. Not only did it fall spectacularly for the 11th month, but it entrenched that it is well and truly below the COVID lockdown levels of activity for the sales of existing homes in the US. So, and not only that, but it's back into global financial crisis territory, and it's actually the lowest it's been, apart from those two events, COVID lockdowns and the GFC, it's the lowest it's been, and it's below COVID, it's the lowest it's been since the 1980s. So it's just a complete collapse of existing home sales in the US, which is probably one of the most reliable indicators of overall economic confidence in the United States. So it completely is falling away. Remember, we had a little bit of a bounce in the University of Michigan sentiment survey for the United States Consumer Sentiment Survey. And I said at the time, it's just a small bounce at depression levels. And it may still fall lower given those home sales results. So not a good US economy. Of course, the market decided it needed to buy stocks on the day on Friday. There are a few factors. One of them was how bad is that housing data, which says how can the Fed keep hiking rates when that economic data is in fact so bad. The other thing that helped was the cutting of jobs at several of the big tech companies. Record staff layoffs, worker layoffs happening in the tech sector in the US, over 100,000 so far in just the last month or two. So certainly a sector in trouble, but everyone on Wall Street keeps wanting to buy the dip on the idea that cutting the workforce reduces overheads and therefore is good for profitability, but it completely ignores the reason for the staff cuts are that their core businesses look bleak a little bit down the road ahead in a sustainable way that requires the offloading of staff. So not a good outlook for earnings in the tech sector, not a good reason to buy that there were layoffs. So be very careful about that spin. The other factor, of course, was that Fed officials said that perhaps 25 points arguments could be made for a 25-point rate hike at the next FOMC. The market got very excited about that with a lot of follow-through after that very poor housing data. The problem with that is that it's really the chairman and his team, internal team, who often hold the sway, or 100% of the time hold the sway in terms of what the FOMC does. I think the chairman and most of the board are probably still very much leaning towards let's get these rate hikes done so we can stop for a while and reassess. And cutting back to 25 points really just means a continuation at a lower pace of impacting more and more pain on US consumers and businesses and mortgage stress, etc. So I still feel they'll hike at 50 points at this next meeting and probably 50 points at the following meeting, because as those oil prices trend higher, there is every risk that the inflation data in the US may actually tick up. It probably will stabilize, but may in fact tick up. And in that environment, the Fed can't see itself reducing rate hikes to 25. So what that means is that the market is now setting itself up for a serious disappointment when it doesn't get 25 points at the next FOMC, but instead gets another 50-point hike It will be accompanied, of course, by comments that at some point we're getting closer to where we will pause to reassess. But certainly they will also, in the same accompanying statement, say that inflation remains very firm. We expect more to come through in the services sector, more in the shelter area, the cost of housing in terms of rents, that is, not prices, because prices are already heading lower in the US in property prices. And don't forget, US is experiencing still depreciated stock prices, falling property prices, bond prices have started to fall again, the US dollar is falling. This is not like the leading light of the world economically by any stretch of the imagination, and be very wary of any investments in the US at this point. So my outlook is still bearish. I see this stock market rally as another period of stupidity, if I may, before reality will again bite. How far this period of stupidity can last, I think it should be topping out Monday, Tuesday this week. I did say before the inflation figure it could run for perhaps 3 days after the inflation number, and that's what we saw. And then we had Wednesday, Thursday, we saw the market falling away in the US rather significantly. Friday's bounce is big, but it retraces just over half of those declines. So I'm kind of a seller of the rally here, but a little bit cautiously. On the currency front, the US dollar's down a long way. I see a bearish argument. I've made it before, but it's fallen a long way. And so I'm sort of looking actually to buy US dollars again, sell Aussie, sell Euro, but it is against the trend and the price action information of the moment. So it's more based on the idea that everyone who wants to buy Euros, Aussie, have pretty much done so, and the market can move lower. If the US dollar were to move lower instead, against that view of mine, in line with market sentiment, then I would think the yen could certainly appreciate, but my preferred view really is to buy dollar yen on the day after another big swing to the upside and back down again. I do think there's just too many of the world's biggest hedge funds and retail investors too, and corporations hedging their exposures who are all short dollar yen or long yen against other currencies. So I do think selling the yen is possibly a good trade for the week ahead. Thanks very much. Clifford Bennett, Chief Economist, ACY Securities.